Welcome to episode 366 of the Postal Hub podcast. I'm Ian Kerr. Joining me in a moment is Professor John Colley from the Warwick Business School. We're going to talk about mergers and acquisitions, in particular Just Eat Takeaway's M&A journey. Joining me on the line is Professor John Colley from the Warwick Business School. John, we're going to be returning to the topic of food delivery. In particular, you've recently authored a case study on Just Eat Takeaway and its adventures in acquisitions and mergers, etc. And you've also written a book called The Unwritten Rules of M&A. We might talk a little bit about the book later on. But John, let's start with just setting the scene for us, please. Just Eat Takeaway was active in the pandemic, wasn't it, when it came to who acquired GrubHub, didn't it?
It did. Yeah, good morning, Ian. Just Eat Takeaway, well, the saga really started during the pandemic when sales soared of takeaway delivery food. Clearly, we were all locked down at home. And so there was a huge increase in the demand for deliveries of takeaway food, much the same as there were for grocery deliveries at home. And that service also went berserk, more or less doubled, shall we say, in demand. At this point, GrubHub, which is was quite a sizable US takeaway delivery business, it actually made its one and only quarter ever of profit, clearly boosted by the demand. Now, there was a belief amongst many that this had broken through the glass ceiling and off it was going to go. Home delivery of groceries and home delivery of takeaway food were just going to, explode and continue their upwards trajectory. Typically, someone had drawn a hockey stick on the top of the demand levels. So up steps Just Eat Takeaway, offers to buy the business for $7.3 billion, which is a huge sum of money for a loss-making business. It was accepted, 2021, the deal went through, so they bought it. After COVID had subsided, though, demand for both home grocery deliveries and takeaway delivery food pretty much subsided back down to where it was before COVID. That is, they hadn't broken through any levels, and that there was a level of demand, and that was it. So losses ensued. Just Eat Takeaway also, clearly, they'd now bought into a lot of losses. The investors were quite unhappy about this. They'd actually backed, I think, the acquisition of GrubHub at the time because they wanted to see the industry concentrating. The belief amongst many investors in this industry is that if you can get it down to very few players, then they'll be able to operate with higher prices. I think one has some skepticism about this particular strategy in this particular industry because of it's so sensitive to pricing and to cost of labor as well. So you've got two big areas which can move either way. So you don't necessarily have control in the market, even if there are only three players. But just the same, so GrubHub was put up for sale then, and it's been 2 years on the block trying to sell it. It's just sold, and they sold it for $50 million net cash to get rid of it. And immediately the sale was completed. Just Eat Takeaway was bought by Prosus for just over $3 billion. Well, it's $4 billion, just £3.4 billion, I believe. So you could see what's actually happened here, that they'd made such a huge error buying GrubHub at an enormous price at the top of the market that the investors have basically told them, we're going to sell out. So they made them get rid of GrubHub and then sold them off to Prosus, which is South African investment arm of Naspers. And thus goes a player. Now, what went wrong? Quite a lot, really. And there were two big problems. One, huge optimism during COVID that this was going to persist, which I have to say, I think was a very, very big bet. The other big problem, and a lot of companies have this problem, is that 2021 and first half of 2022 were huge demand to buy businesses generally. And this immense demand drove the prices of businesses generally through the roof. Up prices went 25%. And I would hazard a guess that almost anybody who bought businesses in 21 or the earlier part of 22, in effect, have overpaid quite significantly. And they will struggle to, if you like, make money. They will have destroyed value through doing that. And clearly Just Eat Takeaway were one who did that anyway. So they got two things wrong: huge optimism around the takeaway delivery market in terms of timing, and then they also had the problem of wrong time in the M&A cycle. That's not the time to be buying a business. So destroyed value both ways.
So this is effectively, you're saying here, the timing of M&A activity is crucial.
Absolutely. It's the sort of golden rule of private equity, that you buy when the market is quiet and down, i.e. demand is low for businesses. And that usually follows two things: liquidity, the willingness of banks to lend, and also corporate profitability. So if there's not a lot of money swilling around looking to buy businesses, then M&A activity collapses. At the moment, it's very low. So typically here we are, 2025 and 2024. So prices are low. So it's actually a good time to buy businesses if someone will sell. But 21, 22 was absolutely rocket high, probably paid 20, 25% more than you would do now for the same business making the same profit. So someone like private equity tries to buy low, and then they try and sell high when demand for M&A demand is quite high. So that's part of their game for making money.
So this timing is a key part of this.
Timing's all in the M&A business. It really is.
And avoiding high prices, which almost sounds like it goes hand in hand with high prices from what you're saying, with timing, as you're saying.
This was even worse in that Just Eat Takeaway believed that Uber Eats were also competing for the business. They believed that. Now, I do think GrubHub had spoken to Uber Eats, but it had gone nowhere. So this drove the price upwards. So, of course, then Just Eat Takeaway buy GrubHub, and then straight away they put it up for sale because demand collapses. Uber Eats has no interest in buying it. So I wonder whether they were there in the first place. So typically, again, that drives the price high. And once you're overpaid for anybody, any business in the M&A world, you're not going to get it back. It's gone for good. It's lost. That's destroyed value.
I'm sure a number of us could think of examples from other industries off the top of our head, but we won't dive into that too much right now. But let's talk a little bit about strategy. You mentioned before that investors bet, I think those are the words you used, or their thinking was that there will be M&A activity in this sector. And so they were investing in, was that their strategy? And how does that then mean, what does that mean for the individual company's M&A strategy?
Yeah, it does mean that they're all trying to concentrate the market. The investors are betting on there being as few players as possible in any market. So typically, if you take the soda market, if what we call Coca-Cola or Coke, there's only really two players in the world. And if you think about this, there's Coke and Pepsi who make the stuff. This is no more than sugar water with a bit of taste. There is no magic in this at all.
How dare you say that? That's sacrilegious. Yeah. This is an industry that runs on sugar-flavoured water, isn't it?
Well, yes, it's sure. Some of it has some other forms of sweeteners in, I have to say. But typically, you can get this made yourself. So there are contractors all over the place who will make up a drink which is similar, quite similar in taste to Coke or Pepsi. But in fact, the two of them make huge profits because there's only, in effect, two of them in the market. The others are all private label or unknowns or whatever. And that's just with, if you like, a product which is not exactly technologically sophisticated. So in effect, it's a similar bet people are making with the takeaway delivery market. It's an unsophisticated product, let's be honest, but that's effectively...
So much sacrilege in this discussion today, John. Now you're saying that all this technology that underpins is not that sophisticated? My goodness, I'm going to get letters. Well, I won't get letters. I'll get comments on LinkedIn.
Yeah, I mean, it's quite difficult to call these businesses technology companies, isn't it? Sure, they have an app. They do have reasonably sophisticated software, but it's not that hard to, if you like, copy. So other people could enter the industry. But the idea is to effectively have a small number of players as possible. And then typically oligopolies don't compete as hard as when you have a large number of smaller businesses competing. So the advantage of a smaller number is that ultimately you hope you will be able to put your prices up. You also hope that your costs will come down through economies of scale. So that's the hope with all of these things. The drawback with takeaway delivery food is that there is a price limit on what people will pay to have their burger or pizza brought round, if you like. So there is a limit there. And also the lower end of the scale, I'm skeptical about the extent of economies of scale you get when in effect you've got to pay people to deliver it. I think there are some, because clearly a rider can carry several orders and make multi-drops and so on if you've got the density of demand. But I don't think it's that great. So that's the bet, though, just the same, which people are making. So that's why, if you like, people are concentrating the industry and buying each other. Having said that, it's still an industry which is struggling to make money.
So is this the strategy then of the companies? Is their strategy to be acquired or to acquire others? Is that what we're getting at here?
I think there are elements of that to it, that investors are banking on one of those two things happening. I think ultimately you're probably better off if you're a seller rather than a buyer. So if you think the shareholders of GrubHub got out with $7.3 billion between them, whereas Just Eat Takeaway shareholders have got out with about $4 billion.
Well, does size matter in mergers and acquisitions?
Size does ultimately matter in most industries. In most industries, size does matter. But it's a question, you want size in a country, because that's where you get your economies of scale and your market power. So if you've got a small market share in 50 countries across the world, that's not much use to you. But if you've got large market share in a couple of markets, that's helpful. That's useful. You can do something with that. So that's the rationale with it. The slightly bizarre thing with this one is that the rationale for buying GrubHub was to become the biggest in the world outside of China. Now, that doesn't give you any more economies of scale. It gives you no integration benefits at all. There are no synergies from doing that. It just means you're big over there in North America and you're big over here in Europe. So that was the, if you like, there isn't a strategy in that other than you want to be the biggest in the world outside of China. What you're aiming for in any acquisition is 1 + 1 = 3. That's the idea, that you put the two businesses together and you get more than the two you bought because of the benefits, which are either cost or market power benefits you can generate from that. In this case, 1 + 1, I think, ended up making rather less than 1. If you think the valuation, Just Eat Takeaway, at the time of the acquisition was about $30 billion. It's just been sold at $4 billion. So it didn't work, did it?
Do we have, in the delivery industry, do we have to accept that the private equity is playing a role in the direction our industry takes?
Well, I think investors are. I'm not so sure about private equity in that particular industry. If you think of the big players, I suppose you can argue that Just Eat Takeaways ended up in a form. It's ended up in an investment firm, a business. I wouldn't describe it as private equity. Uber Eats, another big one in the UK and Europe. That's listed PLC, so that's not private equity. I don't think it's an industry private equity are that interested in, to tell the truth. And I think that the acquisition by Prosus of Just Eat Takeaway is almost a distressed sale level. It's kind of a business. It's picking up a business very cheaply because of, shall we say, its previous management decisions.
Let's quickly talk about your book, John, because you've published a book called The Unwritten Rules of M&A, Mergers and Acquisitions That Deliver Growth, Learning from Private Equity. Tell us a bit about the book and where it's available. Can we use the cliche? It's available in all good bookstores?
Yes, it It isn't generally. It's available certainly on Amazon. You can buy it from Springer. It's readily available. You can get it, but generally it's probably not propped up in your favourite bookshop, although it is in some.
So tell us a bit about what the book's about, the unwritten rules of M&A. Why should we read it?
Yeah, okay. Fundamentally, most M&A goes badly wrong. Something like 70 to 90% of it does not meet expectations, is significantly. So if you happen to be sat on a board and a paper comes up saying, we want to buy company X, the returns on it are going to be Y, you can almost say they aren't. They will not make those returns. 70 to 90% of occasions, that's the case. But the bit which is much more worrying is something like 60% destroy value and around 50% get sold off again, i.e. didn't go very well, so we're selling them off. Now, it's perhaps worth saying that for me, I worked in corporates, and so in effect I bought businesses on behalf of corporates. I was group managing director of FTSE 100 business, and some of them did go wrong. Some did not go well. Interestingly, I have worked with private equity, simply, and on other occasions, it's been my own money. And it's strange how things have got better. What I would say is working with private equity, they're highly disciplined in their approach. They won't overpay. They're very wary of timing. They always have a detailed plan as to what they're going to do with a business when they've got it. And they're active managers, do use debt quite a bit as well. So in reality, what I'm trying to say with this particular book is that we look at the various strategies of M&A, and then we look at how you could benefit by learning some things from private equity. I'm not suggesting all by any means, but if you're a strategic corporate, they do a lot of things which they're very thorough, very disciplined, which would probably benefit corporates as well, probably benefit them. But I'm not saying everything they do, because clearly the objectives are different. Private equity buy a business to improve it, to sell it, whereas strategic corporates buy a business to keep forever. Now, they end up not keeping them forever for various reasons, but that's the objective. So quite different objectives. Corporates are usually trying to get the benefits from integrating the business into the rest of the business, whereas private equity are just looking to improve it through various techniques before they sell it off over something like 3 to 5 year period. So there are differences in their approach, but that doesn't mean to say there isn't something you can learn. Private equity make huge returns on what they do, whereas corporates, shall we say, struggle with M&A. Many of them do.
And while we've talked about food or meal delivery here today, the topic of M&A is an ongoing one in the delivery world. I mean, it's 10 years ago that FedEx announced its deal to take over TNT, and we've seen Singapore Post with its activity over the last couple of years. Now it's just voted in the last week or two to divest itself of all of its Australian acquisitions. And we know, there are a number of delivery companies around the world that have been bought by private equity recently. And given what you've said today, John, it'd be fair to assume, would it, that if a private equity has bought a delivery company, they're looking to transform it into a sellable company. It doesn't necessarily have to be profitable, it just has to be sellable. Would that be right?
Yeah, the idea is to buy low, sell high, and carry out some improvement work in between. Typically with the improvement work, they use consultants, specialist consultants, to try and improve things like the supply chain, improve the logistics of a business, improve if it's got manufacturing consultants, and also go-to-market strategies. So they tend to use specialist consultants a lot to help improve businesses. And you'd be amazed, they usually can improve them quite significantly.
So the book's called The Unwritten Rules of M&A, Mergers and Acquisitions That Deliver Growth, Learning from Private Equity. I'll put a link to it on the episode page on the Postal Hub podcast. So if you fancy buying it, put a link there, probably through to Amazon or wherever we can find it available. Professor John Colley from the Warwick Business School, thank you for joining us on the Postal Hub podcast today.
Thank you.
That's all for this episode of the Postal Hub podcast. We have some great guests coming up very soon on the Postal Hub, but I'm not going to tell you who they are because I've just got to maintain an air of mystery about these things, all right? If you want to be the first to be informed when these episodes are released, subscribe to the Postal Hub podcast in platforms such as Apple Podcasts or Spotify or Amazon Music. You can subscribe to my email newsletter that comes out every time there's a new episode. Go to thepostalhub.com and follow the links there. If you like getting daily news in your inbox daily, delivery news in your inbox every day, then sign up for the Daily Delivery Digest. It's a daily email newsletter with the most important headlines from around the delivery world. If you want to follow me on LinkedIn, you can. Just look for me, Ian Kerr, on LinkedIn, and you can click follow and follow me for all the kinds of LinkedIn goodness. It's better than a load of the other rubbish that's out there on LinkedIn at the moment. And I can guarantee that my content isn't generated by AI. Because I don't know how to use it. No, I mean, it's because I value creativity. If you want to email me at all, my email address is ian@thepostalhub.com. I'm Ian Kerr. Thanks for listening in, and I look forward to your company next time on the Postal Hub podcast.